Good morning. I want to welcome everyone participating in this morning's webinar. My name is Alejandra Jensen, and I am a nonprofit audit manager at Gelman, Rosenberg Freedman, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what participants need to do to earn CPE credit for today's webinar. For the best sound quality, we highly recommend you connect by phone instead of your computer. If you have any technical questions or issues during the webinar, please use the chat function to speak with our webinar administrator for assistance. Please note this webinar will be recorded and made available on our website following the event. The slides will also be posted at this address, www.grfcpa.com/webinars. Webinar participants seeking CPE credit for this presentation must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. Please write down the CPE words when they are given. They will not be provided again. You will be asked to recall these words in order to receive the credit. If you have an active pop-up blocker, please take a moment and disable it now so it will not block the survey. Any technical questions about the survey may be addressed to Dominic Acosta at dacosta@grfcpa.com. As the title of the webinar implies, today's learning objective is to provide attendees with a better understanding of the requirements and implementation of Topic 605 and Topic 606. One CPE credit is available to attendees of today's webinar. With that all said, welcome to today's webinar, New Guidance for Recording Contributions, Grants, and Contracts. Walt Arangowski is a nonprofit audit partner and has over 15 years of public accounting experience with Gelman, Rosenberg Freedman, servicing the nonprofit sector exclusively. He manages audits for a wide variety of nonprofit clients like trade associations, charitable organizations, non-governmental organizations, private foundations, political action committees, and other similar institutions. Trevor Williams is also a nonprofit audit partner and has worked in public accounting for over 22 years. He has extensive experience with audit functions, contractual compliance rules, regulations, policies, procedures, and accounting operations. He is active in the firm's implementation of the latest statement on auditing standards concerning the assessment and response to audit risk in a financial statement audit. With that being said, I will hand it off to Walt.
Thank you, Alejandra, and good morning and happy Thursday to all. Trevor and I are really pleased that you could all attend today's webinar. We will briefly be discussing the ASU 2018-08, Topic 605, and ASU 2014-09, Topic 606. These topics are considered to be the most significant piece of guidance issued by the FASB in recent years. For some nonprofits, the accounting changes will be minimal and only new disclosures will be required. However, for other significant accounting and reporting changes will be needed in addition to new disclosures. Today's agenda, we will briefly discuss the criteria for exchange transactions versus contributions. Next, go through conditional versus unconditional contributions, which will lead us into ASU 606, which Trevor will cover in detail later, and go through the 5-step model. Then we will close the discussion by identifying practical steps for implementing the new revenue recognition standards. And at the conclusion, we will have some time to respond to some questions that may have been posted. So, on June 21st, 2018, the FASB issued Accounting Standard Update 2018-08, which clarifies the scope and the accounting guidance for contributions received and contributions made. This ASU is approximately 70 pages long, and I highly recommend everyone read the pronouncement, as it has some really good examples that could help your organization out when implementing. So the big question to ask is why these new ASUs? So for many entities, revenue is the single largest amount in their financial statements. So management, lenders, those charged with governance, and other stakeholders focus on revenue to monitor an entity's financial performance and general financial health. So several years ago, FASB and IASB, the International Accounting Standards Board, undertook a project to converge portions of US GAAP and IFRS and selected revenue as one of the areas to pursue. Both of the boards identified weaknesses in their existing accounting guidance for revenue, and both boards, they recognized their existing disclosure requirements were not adequate to provide financial statement users with sufficient information to understand an entity's revenue. The objectives of the projects were to create a more robust framework for addressing revenue, simplifying financial statement preparation, and improve the comparability across entities and industries, and remove the weaknesses and inconsistencies, and improve the overall usefulness of the financial statements through those enhanced disclosures. So let's jump in. And we're going to start talking about implementing the new ASU 2018-08 and discuss grants and contracts. This ASU clarifies and refines existing guidance in subtopic 958-605 by adding paragraphs that set the scope of the subtopic and providing illustrative examples. First, the scope applies to all nonprofits and business entities that receive or make contributions unless otherwise indicated. And this is just an enhancement to the revenue recognition standards that we have in existence as of today. Second, it excludes transfers of assets from the government to business entities. Third, applies to both contributions received by recipient and contributions made by a resource provider. So it is a standard that does apply to both the makers and the receivers. The intent is simply that both apply the same guidance, but keep in mind the entities do not need to track each other's accounting to achieve that same reporting. And fourth, how an entity labels revenue in its financial statements, for an example, grants, contributions, donations, is not a factor in determining whether an agreement is in the scope of the guidance. One thing I want to mention here is that the key to this standard and the changes is who receives the benefit. And the first issue as we were looking at the standard is to talk about the conversation of whether this is an exchange or a contribution, which are terms that we used in the past. But to distinguish as this being as a reciprocal type transaction or a non-reciprocal type transaction. Reciprocal transaction is what we consider an exchange type transaction, and both parties of the transaction are benefiting and would therefore be treated as an exchange transaction under ASU 606. And maybe this is not of what we thought of as an exchange transaction, but you are truly exchanging value and the recipient is getting something of equal value, as opposed to non-reciprocal transactions whereas one side is not receiving the benefit of the transaction. Here are some of the key provisions in helping identify and clarify these two issues as indicated on the previous slide. There are differentiators between a contribution and an exchange type transaction. An exchange transaction will have an exchange of commensurate value, and it will also be a reciprocal benefit that will flow between the parties. And then on a contribution, the benefit actually flows to the public. So ultimately, if the result is serving the general public, such the general public is receiving that primary benefit, then it's considered a contribution because there is really no reciprocal benefit to be identified. One thing to note here is the resource provider does not matter. It could be a government agency, a private foundation, or even a corporation. And one other thing to note here as well is federal grants could be either an exchange transaction or a contribution. Certain federal grants, there is a reciprocal benefit. So the federal government may receive something in return, maybe educational training for their employees or some other item of commensurate value. But other federal awards are clearly for the benefit of the public. So you'll have to look at each grant and contract closely and to determine which guidance is applicable. So then basically, once you determine if in fact a contribution you have and determine if it's, you have to determine if it is conditional or unconditional. If you determine the contribution is unconditional, then you go back to the current definition of a donor imposed restriction and determine if you have any restrictions or not. So you're back to the basic purpose of time restricted that we have been dealing with already. Unconditional contributions are recognized immediately and classified as either net assets without restrictions or net assets with restrictions using the new terminology. Distinguishing between a condition stipulated by a donor and a restriction on the use of a contribution imposed by a donor may require the exercise of judgment. Now, what makes a contribution conditional? Basically, there are two components. A donor-imposed condition must have a barrier and a right of return or a right of release. This is basically determined by the agreement, and it doesn't have to specifically say there is a right of return or a right of release from the obligation. But the agreement should be sufficiently clear to support that conclusion about whether that recipient is entitled to the transfer of that asset. Now, let's see what determines what a barrier is. So some indicators to determine a barrier. First, there is an inclusion of a measurable barrier. If there is a specified level of service, for an example, they say you must provide 50 meals per week to the homeless shelter, or there is a specific outcome identified. For example, there must be a reduction of dropouts in the educational setting that is part of the award. Or maybe there's a matching component. I think that is probably one that we have known in the past and always considered conditional. But if there is a matching component, then it is a measurable barrier. In addition, if there is if there are stipulations related to the purpose of the agreement, like a specific event or activity that would make it a barrier or in the agreement. This generally excludes administrative tasks or trivial stipulations that are unrelated to the purpose of the agreement. For an example, if there is an annual report that has to be provided to receive subsequent annual payments on a multi-year award, that would not be considered a barrier. The annual report is deemed unrelated to the underlying purpose. Limited discretion. This also could indicate a barrier. If the nonprofit has limited discretion on how the transferred assets are spent, and definitely an area that could be difficult to discern, but they've encouraged you to use some judgment in assessing this. They say if something is given for broad support, say for the next year's operating budget, and that's the only requirement, they wouldn't really be limited to discretion and it wouldn't be considered unconditional. Just to clarify, some contributions may have a right of return, but not barriers. And they may even have restrictions. Those would be donor restricted, but unconditional if they don't contain any barriers, because you have to have both to be conditional. And if you have a transfer of assets that is determined to be conditional contribution, it should be accounted for as a refundable advance until the conditions have substantially met or explicitly waived by the donor. There are several examples in the guidance that I suggest you take a look at. I think a lot of them will apply to your organization, but one example I want to quickly go through is on federal awards. They basically went through and decided that this particular federal award in the example was a contribution and not an exchange transaction in this case. And they determined that the federal award is conditional because of various barriers, including the specific requirements on spending in accordance with OMB compliance requirements, adherence to cost principles. The audit requirement alone is not a barrier since it's not related to the purpose of the agreement. The federal award also has a right of return because any assets that would be used for unallowable items would have to be reimbursed, and there is a release of obligation for unused assets or unspent funds. So before, many may have treated federal grants as an exchange transaction regardless of the substance. Now, even though people may not have thought of government funding as a contribution, it's actually going to go down that contribution route. The chart in the slide is just a decision chart, and I'm not going to go through this in detail, but it's a good chart to look at and to determine this process and to determine if you have the exchange transaction, or are you going into topic 606 or where you have a conditional or it's unconditional. This chart comes up in various seminars and comes directly from the FASB ASU, so I think it's something very useful to have it on hand. The transition approach and effective date. So this does apply to all agreements entered into after the effective date and those that are existing at the effective date. But it only applies to the portion of the agreement not previously recognized. So there is no prior period adjustment that would need to be restated and no cumulative effect of adjustment for opening balances. Retrospective application is permitted if you would like, and the effective date of this is basically the same as topic 606, which Trevor will discuss later.
All right, thank you, Walt. We have come to our first polling question. What impact do you think revenue topic 605 will have on your organization? It will have a major impact on my organization. It will impact my organization a little, but not greatly. It will not impact my organization in any noticeable way. I do not know yet. Please take a moment now to answer. While participants are recording their answers, I'll provide the first CPE word. The first CPE word is fall. If you want to receive CPE credit, please jot this word down because you will need it for the survey emailed following the webinar. Again, the first CPE word is fall, F-A-L-L. All right, and I will turn it over to Trevor with the results.
Thank you, Alejandra. In taking a look at the results here, it seems the majority of the respondents have said that it will impact my organization a little, but not greatly. And second is I do not know yet. And I must be honest, that is a response that we have heard quite a bit, hence why we felt it was time to have this particular webinar for you all today. So now on to topic 606, the core principle of the new standard. The objective of this particular standard is to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. Current GAAP uses a rules-based approach to revenue recognition so that revenue can be recognized as certain rules are met. Under this new guidance, it utilizes a principle-based approach that often requires you to apply more judgment when considering certain matters, such as contract terms or other facts and circumstances. Each industry will need to interpret and apply the principle-based guidance to their transactions. And there are two key principles that apply when accounting for revenue. First, the revenue should be recognized in a way that reflects the transfer of promised goods or services to customers. And secondly, the amount of revenue recognized should equal the consideration to which an entity expects to be entitled for those promised goods or services. Effective dates. For public entities, the effective date to implement Section 606 for annual reporting periods beginning after December 15th, 2017, including interim reporting periods within that reporting period. So effectively, that means for your year ending December 31st, 2018 is the first year to adopt. Because again, it's for annual reporting periods beginning after December 15th, 2017. Before going on to the next bullet, I just wanted to take a minute to point out the definition of a public entity, because that may impact some nonprofits here on this webinar. The definition of a public entity is defined in the codification as a public business entity or a nonprofit entity that has issued or is a conduit bond obligor for securities traded, listed, or quoted on an exchange or over-the-counter market. And third, an employee benefit plan that files or furnishes financial statements to the SEC. So again, if your nonprofit organization meets those definitions or any of those definitions, it's deemed to be a public business entity and subject to this particular standard and should be implemented for fiscal years or annual reporting periods beginning after December 15th, 2017. All other organizations, including nonprofits, the effective date for annual and interim reporting periods beginning after December 15th, 2018, and any interim periods in the subsequent annual period. Early application is permitted within certain limits. So effectively, for those organizations, December 31st, 2019 will be the first year to adopt within that category. Here we have some examples of exchange transactions that you will typically see in your various revenue streams. And again, these types of revenues would be subject to topic 606. Membership fees, sales of products or services, naming rights, sponsorship, special events, grants and contracts. Additionally, you may have to bifurcate transactions as necessary. And basically this means the transaction may include a little bit of both, and by that a contribution as well as an exchange transaction, so that you must separate them. And again, here you have considerable judgment. Contracts with customers that are specifically excluded, lease contracts, insurance contracts, financial instruments, and other guarantees. Because Gelman, Rosenberg, Freedman works with quite a few membership organizations, we added this particular table, the indicators useful for determining contributions and exchange portions of membership dues. Without going into each of these indicators in detail here, I'll just point out a few. Basically, if the membership benefits are really going to the general public, then they should be recognized as a contribution and not membership revenue. However, if the benefit goes to the members or those related to the members, then it's most likely deemed to be an exchange transaction. You should also look to the extent of the member benefits. If the member benefits are minimal to your membership, then that membership due should probably be treated as a contribution. On the flip side, if the benefits are substantial, like publications, registrations, or conferences, and they are available to be purchased by non-members for a fee, then they should be treated as an exchange transaction. Next, I'd like to go into the 5-step model that the ASU has developed. This should help us to determine how revenue is to be recognized. And before we go into detail, I'd just like to briefly mention each of the 5 steps. Step 1 is to identify the contract with the customer. Step 2, identify the performance obligations in the contract. Step 3, determine the transaction price. Step 4, allocate the transaction price to the performance obligations in the contract. And step 5, you recognize the revenue when or as the entity satisfies a performance obligation. So step 1, identify contracts with the customer. Before we define a contract, the first thing we need to do is define what a customer is. And the customer is the party that is contracted with the entity to obtain goods or services from that entity. The definition of a contract is that a contract is an agreement between at least 2 parties that includes enforceable rights and obligations. And there are 2 things to point out here in that definition. The first of which is that the contract does not always need to be in writing. It can be oral or implied by an entity's customary business practices. And second, I'd like to point out in that definition of a contract, the term enforceable rights and obligations. And those enforceable rights and obligations are by law. So you will have to consider federal, state, and local law to determine whether or not the contract is truly enforceable. Step 2, identify the performance obligation. So after you've identified the customer contract, then you have to identify the performance obligation. A performance obligation is a promise with a customer to transfer distinct goods or services to that customer. This concept is similar to the concept of deliverables in prior revenue standards. In a basic sales transaction, the good is available for sale and the customer decides to purchase it. In a service transaction, the performance obligation may be a one-time obligation, or it may be a continued service over a period of time. If multiple goods or services are promised in a contract, they may need to be combined into distinct bundles. In order for a good or service to be considered distinct, both of the following must be true. If the customer can use, consume, or sell the item either alone or together with any other resources readily available to the customer. And secondly, if that good or service can be separately identified from other promises in the contract. Step 3, determine the transaction price. The transaction price is the amount an entity expects to be entitled to for fulfilling its obligation to transfer the promised goods or services to a customer. Usually this is stated in cash, but could include non-cash items such as shares of stock. If the transaction price or consideration is variable, there will be significant judgment needed to estimate that transaction price. A key item to note here is if variable consideration depends on the occurrence of future events, such as a performance bonus that depends on meeting specific deadlines, you are permitted under this standard to include your best estimate of the variable consideration to which you'll be entitled to in the transaction price. You do not have to wait for the uncertainty to resolve itself before starting to recognize it. And as such, this would result in recognizing revenue earlier. When deciding how much variable consideration to include in that transaction price, you are limited to an amount that is not probable of a significant reversal of revenue when that future event does occur and that amount does become known. Again, the transaction price does not include amounts collected on behalf of third parties. You should consider the time value of money, again, non-cash consideration and consideration payable to a customer, for example, coupons and credits, when determining the transaction price. And again, this may consist of fixed amounts or variable amounts or both. And again, by variable amounts, we're referring to discounts, rebates, transactions such as those. Step 4, allocate the transaction price. Allocate the transaction price to each performance obligation based on the amount of consideration an entity expected to be entitled to in an exchange for satisfying the performance obligation. The goal of dividing the transaction price to identify the amount a contract entitles you to in exchange for satisfying each performance obligation. So if the contract has only one performance obligation, then it's really quite easy. The transaction price can be attributed to that performance obligation. However, if there are 2 or more performance obligations, you have to allocate that transaction price to each performance obligation. To determine that standalone selling price, it is preferable to use observable prices or estimates using observable inputs such as market assessments, cost plus margin, or a residual approach. You will also need to consider types of discounts or other variable consideration. Sometimes that might apply to a specific performance obligation, and other times it may need to be allocated. And last but not least, step 5, recognize revenue when or as performance obligations are satisfied. In short, you earn revenue when you satisfy a performance obligation. That is when the customer gets control of the good or service that makes up that performance obligation. Again, the good or service is considered transferred when or as the customer obtains control. That's a key term, control. A performance obligation may be satisfied over time or at a point in time. And the control factors here are control of an asset refers to the ability to direct the use of and obtain all of the remaining benefits from that asset. Additionally, the ability to prevent other entities from directing the use of and obtaining the benefits from an asset. And again, there are 2 types of control, over time or at a point in time. This particular slide lists some more criteria that must be met to establish control and thus the recognizing of revenue. Again, you have the recognition when performance is satisfied over time, and that you recognize when performance is satisfied at a point in time. And I will turn it back over to Alejandra for polling question number 2.
Thank you, Trevor. Our second polling question is a follow-up to the previous polling question. Will you have to bifurcate revenue streams in order to be in compliance with new regulations? Yes, we will have to bifurcate revenue streams. No, we will not have to bifurcate revenue streams. I do not know if we will need to or not. Please take a moment now to answer. While participants are recording their answers, I'll provide the second CPE word. The second CPE word is revenue. If you want to receive CPE credit, please jot these words down because you will need them for the survey emailed following the webinar. Again, the second CPE word is revenue, R-E-V-E-N-U-E. With that being said, I will hand it back to Trevor with the results.
Thank you, Alejandra. In tabulating the results, it looks like the majority of you that had responded went with the third option. I do not know if we will need to or not. And we actually expected to receive that response on this particular polling question as well. The next couple of slides takes us through an example regarding membership dues. We felt as though it would be helpful to see the differences with this new standard and how it impacts the various revenue streams and the recognition of this revenue. In our example, the members paid $1,200 for annual membership, which includes 2 journals that are distributed in May and December, and free admission to an annual expo, which is held in March. John Smith became a member on June 1st, 2020, and paid his annual membership fee in full. The nonprofit organization has a calendar year, and it costs $200 to produce each journal, and they charge $300 to non-members to attend the expo. Other various member benefits provided only to the members are valued at $240. So in this particular scenario, this slide is showing the various journal entries and the totals for fiscal year 2020. Under current GAAP, on June 1st, 2020, the entry is to record the cash received, so there is a debit to cash and a credit to deferred revenue for membership dues. Under topic 606, upon receipt of that initial $1,200 fee, you'll see the journal entry is quite a bit different. You have the debit to cash of $1,200. However, we have contribution income of $260, deferred revenue of dues of $240, deferred revenue for the journals of $400, and deferred revenue for the expo at $300. Again, based upon the specific amounts noted in the assumption on the previous slide, this is the proper way to record this particular transaction under the new standard. In continuing on, each month the organization would recognize 1/12 of that $1,200 of revenue. So again, for the remainder of 2020, from June to December, they would recognize $100 per month. And looking on the right-hand side under the new standard, you'll see the amount is quite different. The organization would recognize $20 a month as opposed to $100 a month. Again, because we've now allocated each of the member benefits to a specific category, when the initial transaction occurred, we had deferred revenue for dues of $240. So we would ratably allocate the $240 over the 12 months and recognize $20 per month of membership dues. In December, under current GAAP, no entry to be made. Again, we would just be recognizing the $100 per month. However, under the new standard, when that journal is produced in December, we would recognize that portion of the membership fee for journal revenue. And again, under the scenario, the journal is $200. At year end, you see under current GAAP, we have dues revenue, 7 months, $700. Under the new standard, we have contribution income of $260, dues revenue of $140, again, $20 at 7 months, and the total journal revenue of $200. So under the 2 standards, you'll see under the current GAAP, we have a total of $700, and under the new standard, you'd have total revenue of $600. This slide continues the transaction for the remaining of the membership period for 2021. Again, under current GAAP, you'd recognize $100 per month of membership dues revenue. And under the new standard, again, we're at $20 per month. In March, the expo takes place, and at that time, the organization would be able to recognize $300 for the expo. And in May, the second journal would be produced to the members, and the organization under the new standard would recognize that $200. So at the end of 2021, you'll see under the current gap, the organization recognizes $500, and under the new standard, the organization would recognize $600. So again, just wanted to give you a real simple example to show you all how this particular standard will impact your organization and revenue recognition. So now let's talk about implementation options. FASB ASC 606 requires a retrospective adoption using either a full retrospective approach for all prior periods or modified retrospective adoption. Under option 1, you can apply retrospectively to each prior reporting periods presented. For completed contracts, you do not have to restate contracts that begin and end within the same annual reporting period. For completed contracts having variable considerations, you may use the transaction price at the date the contract was completed versus estimating variable consideration amounts in the comparative reporting periods. And for all reporting periods presented before the date of initial application, you do not have to disclose the amount of the transaction price allocated to remaining performance obligation and explanation of when the entity expects to recognize that amount in revenue. So again, under option 1, there's quite a bit of work to do. Regarding option 2, under this option, you are able to adopt the new guidance retrospectively with the cumulative effect recognized in the opening balance of net assets, the date of initial application. So comparative periods would not have to be restated, and rules apply to contracts that are incomplete at the date of initial application, and you would have to provide additional disclosures on how each line item in the current accounting period compared. Lastly, there's options 3. And under this option, you are allowed to report a single year financial statement versus the comparative in the year of adoption. So as you can see, of the 3 options, option 1 is the most involved, whereas option 3 is the least involved. Now I'll turn it back over to Alejandra for polling question number 3.
Thank you, Trevor. We have come to our last polling question. Have you started identifying potential revenue streams that will be impacted? Yes, we have started. No, we have not started. I am not sure if we have started or not. Please take a moment now to answer. While participants are recording their answers, I'll provide the third CPE word. The third and final CPE word is standard. Again, the final CPE word is standard. STANDARD. With that being said, I will hand it back to Walt with the results.
Thank you, Alejandra. And it looks like the majority have said, no, we have not started, but it's kind of split between, yes, we have started. So, this ASU is coming around, and it's going to affect a lot of the nonprofits that we service. So we're hoping that the management in the organization is looking at this. So we have come up with an implementation plan for you for topic 606, and some of this you can incorporate into for topic 605. And first and foremost, you should read the standards. I know we mentioned earlier how long the standard is, and hopefully you could all get through that. I believe topic 606 is approximately 150 pages, and topic, as I noted, 605 is approximately 70 pages, but there's a lot of good guidance there, and it's a lot of good examples that you could use and incorporate into your organization. You're going to want to assign a member to become an expert. One person will be that expert for you, but you will probably need to help with many other departments within the organization. The person you assign is going to have to meet with the membership department to identify the benefits and values charged to non-members. And under grants and contracts, you're going to have to review all grants, contributions, and contracts, because you're going to have to identify if it is a reciprocal type transaction or a non-reciprocal type transaction, and then identify which route it's going to go through. And again, document that decision process for each grant and contract. Hopefully, you will have similar ones in nature, so you will be able to follow what you have decided on the other grants and contracts using that same methodology. But there will be a need to review each item, because there could be some items that could make it different from the others. And then you're going to want to look at your chart of accounts and basically compile a list of all your revenue streams and determine which revenue streams are going to be impacted. And then obviously, if they're going to be impacted, you're going to want to develop a position paper on each revenue stream and identify what the steps are in your 5-step process and how are you going to be treating those revenue streams. Another piece which I think is going to be crucial is actually discussing with conclusions with some of your peer groups, making sure everyone is looking at the items in a similar nature. Another step to do is deciding if that changes material. If you have to do that analysis to figure that out, if no, then document annually and discuss with your auditor. Of course, if yes, you're going to want to analyze the impact on your organization. And again, contract terms can change from year to year and membership benefits may realign. So this is not something you do once and be done with it. This is something you're going to have to look at each year. You also are going to want to communicate all these changes. The entire organization, from the executive director, the board, the audit committee, as I mentioned, the other people within the organization, everyone is going to need to be aware. It's not only going to be an accounting issue. And again, people who are negotiating those contracts are going to want to be aware of about what kind of terminology has to be included or not included in those contracts, and how you want these to play out, and how you want the recognition process is going to work. And then you determine that transition plan, how and when, and how it is going to be implemented and when is it going to be implemented. Next, develop a plan for the staff training. Again, as I mentioned, this does not only affect the accounting department, it's going to affect the development, your membership, it's going to affect many others in the organization, and coming together to be in compliance with this new standard. And then finally, update your policies and procedures. Your accounting manuals are going to have to be updated to show the new revenue recognition standard. As part of our audit process, we are going to be asking for those updated policies and procedures so we could test accordingly to the plan that you have developed, and make sure you're in compliance with the decisions you have made regarding recognizing revenue under topic 605 and topic 606. Now, I know this is a lot of information in a short amount of time, but we'd like to hear from you if you have any questions.
Thank you, Walt. And I believe some questions have come in. The first question is, what is the difference between a condition and a restriction?
Alejandra, I'll take this one. And that's a good question. And to meet the definition of a condition, it must contain a barrier, and it has to have the right of return or that right of release. In the old terminology, they used to talk about future and uncertain events. This has been replaced with the new barrier concept, and hopefully to reduce the diversity of how people were recognizing items. The donor imposed restriction is still based on the current definition. So that includes how broad or narrow the purpose of the agreement is and when it can be used, or if it can be used at a specified date. So that goes back to your time and purpose restriction, which are different than the barriers or right of return.
Thank you, Walt. So the second question that came in, what if you determine the membership benefits are minimal? Can you split the contribution between years if your year end doesn't coincide with the membership year to be able to have revenue in the following year?
Walt, I'll take this one. It sounds like from this particular question, it sounds like maybe the source is looking for an answer. I hate to be the bearer of bad news on, but unfortunately, no. If your membership benefits are minimal, you would have to recognize that as a contribution upfront when it's received. So your membership year and your year end for your organizations, if they are different, it may and it probably will have an impact on your organization. But again, to answer that question, you will have to end up recognizing that as a contribution up front. And then in that following year, you will not have that revenue to recognize relating to that membership fee.
Thank you, Trevor. The next question, if you go to the calculation of the new revenue standard and the change is not material, do you have to adopt?
Thank you, Trevor. I'll take this one. So this is a new accounting standard, so everyone needs to adopt the standard at the applicable adoption date. However, if you go through the process and you are looking at what the dollar amount is versus what you have done in the past, and it is immaterial, I think you could choose not to make that adjusting journal entry. However, you have to look at this each year to determine materiality. So this is an ongoing contract or ongoing exchange transaction. You will have to look at that. The auditors coming in are going to be looking at this as well. And if this is immaterial, this maybe need to be disclosed on the auditor's AUC 260 governance letter to those charged with governance, informing them that they were passing on the audit entry way into the revenue recognition. So it may just be easier to post the adjusting entries even though they are immaterial.
Thanks, Walt. Next up, what transition option for implementation will GRF recommend to their clients?
I think I can take a stab at this one. It really depends. That's the short answer. It depends, and it basically depends on the needs from the financial statement users of those financial statements. So with that being said, I think the easiest is probably that standalone statement, which is option 3. And the second easiest option would be option number 2, where you just show the cumulative effect and it's recognized in the opening balances of net assets at the date of initial application. But again, it really is going to depend on what management and those charged with governance is looking for and how they want their financial statements presented in that year of adoption.
Thank you, Trevor, and I believe we have time for a couple more questions. Do you need to bifurcate different transactions when dealing with grants and contracts revenue, just like those with membership revenue?
Trevor, I'll take this one. Yes, we in our webinar we looked at the bifurcation with the membership, but you are going to have to do something similar to that when you look through grants and contracts and determine if there is a piece of that grant or contract that is an exchange transaction or a piece that is a contribution. Hopefully, it will just be determining one or the other on the total award, but I think you will run into some scenarios where you will have to bifurcate one agreement and go through the routes of revenue recognition accordingly.
Thank you, Walt. And another question, will cost reimbursable grants be affected by the standard?
I'll take this one as well. Again, just to piggyback on the prior year response, yes, basically it's all grants and contracts. You have to go through the process and decide if they are exchange transactions or contributions. And cost reimbursable contract or cost reimbursable awards, it's going to depend. You're going to look at the substance over the form to decide if it's true contract and consider it an exchange transaction or consider it a contribution.
Thank you, Walt. And the next question, by when do all grants and contracts need to be operating accordingly to topic 605 and the 606 requirement?
I'll take this one. That goes again back to that effective date slide that I addressed a little bit earlier in this webinar. Again, if you meet the definition of a nonprofit organization, it would be applicable for reporting periods beginning after December 15th, 2018. So again, for most organizations, the first opportunity to implement this particular or these particular standards would be on your December 31st, 2019 year ends. But again, if you meet that definition of a public entity, and again, a public entity is one of three things. You're definitely a public business, a nonprofit entity that has issued or is a conduit bond obliger for securities traded, listed, or quoted on an exchange or over the counter. And third, if you are an employee benefit plan that files or furnishes financial statements to the SEC. If you meet those definitions, you would be applicable for fiscal years beginning after December 30th or December 15th, 2017. So for those organizations, you'd be applicable for year end December 31st, 2018. So again, if it's a public entity, December 31st, 2018. If you're a nonprofit or other organization, December 31st, 2019.
Thank you, Trevor. And I think that's all the time we have questions for. Well, GRF would like to thank everyone for attending today's webinar. We would like to invite you to join us again on October 16th at 11 a.m. on how to implement effective internal controls with built-in QuickBooks Online tools and earn 1 CPE credit. For more information and registration, visit us at www.grfcpa.com/webinars. If you have any additional questions after today's program, please reach out to us. Our contact information appears here. And please remember to complete the email survey that follows if you would like to earn CPE credit for attending today's webinar. Thank you again for attending and have a great day.